Hey, Bowtie Nation, Joseph Hogue here, coming at you on another live stream Sunday. Haven't been doing a lot of these lately. I've been working on a big project coming out December 6th, actually, that something we've never done on the channel before. Just a really big project for 2022 that I'm really excited about getting out, but it's taken up a lot of time. So haven't been doing the live streams. Glad to be back with you though. And you know me, I love doing these when we can on Sundays, just to kind of connect with you out there in the Bowtie Nation and, connect a little bit closer than we usually can on the, in the regular videos. What a video today, folks. You saw what happened on Friday. We had a new variant of the COVID. It sent stocks down more than 2% in the major indexes. A lot of stocks got hit a lot harder. A lot of those travel and leisure stocks we'll talk about down more than 10% on the day. And that was already from weakness earlier in the week from, just regular COVID cases ramping up in the United States, in Europe, and it looking kind of bad during getting into the winter. So we're going to get started here. We're going to talk about it was Friday's sell-off. I don't want to call it a crash yet, obviously. Was Friday's sell-off the start of a crash, or is it a buy the dip opportunity? See a lot of people asking that question in the comments, so I wanted to address that today. Give you the stock market news around this new variant, when we might see some information on it, and how to tell whether to buy, sell, hold, what to do, and actually give you a strategy for over the next 2 weeks, 2 months, that kind of thing, so you can make more money. So we're gonna get right into it. Actually got some Cyber Monday deals to announce, only through tomorrow, only through Monday. We're dropping the price of all the courses, the video courses here on the channel, down 50%. I've put links to those in the video description below, so check that out. We've got 3 video courses down there. We've got one on just kind of a lifelong investing strategy, really a stress-free strategy that anyone can use to customize their investing strategy, their plan around their goals, to make sure that they meet their goals, not just investing in stocks and hoping that you meet those lifelong goals. So a lifelong investing strategy for those buy and hold investors. We've also got a stock signals course for those that want to know those stock signals for when to buy, when to sell, and some of that technical analysis. Great course I did with Thomas Carvo that we just released a few months ago, as well as a YouTube course, right? How I built this YouTube channel from really 0 to, it was 75,000 subscribers in the first year. Now it's over 500,000 subscribers just a few years out, and really built it into a full-time business. So, 50% off all those courses. Check those out in the description below. Only through tomorrow though, only through Monday, Cyber Monday. So if you're interested, check those out. And then of course, after we get through with today's material, I'm going to hit that Q&A. Love that section. Just kind of a chance to connect and go back and forth with you on stocks and what to buy. See a lot of you from the Bowtie Nation already in the chat there. Love seeing everybody there. Germany, London, Puerto Rico. Good to see you. New York. Love seeing everybody there in the chat, and looking forward to talking to you in that Q&A section. Going to get started right now. Next week, actually, we've got 2 videos coming up. We're updating our 12 dividend stocks for weekly cash flow portfolio. Did a portfolio video about a year ago, which was a 12 dividend stock portfolio, 12 dividend stocks that would strategically give you a dividend payment every single week of the year. Okay, so dividend stocks, they pay out 4 times a year. So you can actually strategically pick 12 dividend stocks out there to get cash pretty much every single week, which is obviously a great feeling, being able to pay your bills every week with just your dividend stocks. Updated that portfolio, a new portfolio with 12 different dividend stocks coming to you. I think that's Monday, that's tomorrow actually, and then a monthly dividend stocks coming out on Wednesday. So look for those videos. But I want to get started because this is all the market is watching. I just finished up putting together the Bowtie Weekly, the newsletter we send out every week on Sunday night. And we always started off with what to watch in the week ahead, right? And we start off with, the economic news and the trends and the earnings coming up. But, this week, what to watch is only about the variant, is only about COVID, because that's all the market is watching. That's what's going to affect the market, really. So if you've been in Iraq or in a cave over the last couple of days, a new variant was discovered in South Africa. New variant is called the Omicron variant. So after Delta, they go by Greek letters there. So we had Delta and now Omicron, which, if every time you hear that, you're like me, you think Omicron Persei 8, and you know what I mean there. Good stuff. But anyway, that Omicron COVID variant was discovered in South Africa. It's already reached a lot of other countries. It's already reached the EU, Hong Kong, as far as Belgium, the London. It hasn't been discovered in the U.S. yet, but that's something we're going to talk about and something maybe you need to watch for. Now, what's interesting or what's scary really about this new variant and what made the market sell off by 2%, more than 2% on Friday, is this thing has 30 mutations, okay, with 10 to just the receptor binding area. Okay, so now that's how viruses live. That's how they survive, right? They viruses live off a host, but they know that host, that person or whoever has that virus is going to be developing antibodies, right? And we can even develop those vaccines to give ourselves those artificial antibodies and fight those viruses. Well, viruses have evolved to be able to adapt to that and to survive. So what they do is, they mutate. The cells, the viruses mutate to different kinds of viruses to try to find one mutation that is more easily spread. So spread from person to person. We saw that with the Delta virus that was it was something like 10 times easier to spread from person to person than previous, from the original COVID strain. But they also adapt different mutations to find one that is resistant to vaccines and resistant to how people are developing those antibodies and that kind of thing. And what is scary about this new Omicron variant is that it's got those 30 mutations total. So it's very much different from that original strain, and the 10 to the receptor binding area. And the receptor binding area is really the first contact that the virus has with a host body, right? So that's how it binds to and makes someone sick. So the more mutations, the more different that is, than the original strain, which those vaccines were based off the original strain, right? So every time the virus mutates and then has a mutation of the mutation and a mutation of that and so on, for as much as different as that virus gets from that original strain, the more likely there is to find a mutation that is vaccine resistant, right? That the vaccine no longer really works for keeping people safe or keeping people healthy, right? And that's, of course, when we have the problem, is because then we have to kind of start all over. We have to develop new vaccines. We have to get people vaccinated again. And that's when you have the very real potential or the possibility to have a more lockdowns. Okay. So you know what? I'm gonna just delete hide a couple people from the chat. If you believe COVID is a hoax, this probably isn't the live stream for you, because that's what we're talking about. That's what we're talking about how the market is affected by this new COVID, this new COVID news. And if you don't believe in it, then I guess you could still believe in how the market's going to react to it. But you gotta own up to it, dude. It is a thing. It's not a conspiracy or anything like that. Anyway, back to it though. For reference, the Delta variant, so transmissible. In fact, we can look on the at the new or the cases, and this COVID, when we hit like 200,000 cases in the U.S. there in August, late last year. That big bump, that was the Delta variant. Okay, so it was much more transmissible, much more deadly than that original strain. And what they're talking about, and that only had 2 mutations on that receptor binding area. Okay, and so we're talking about the Omicron one has 10 mutations. So could be much more transmissible, much easily to infect people. Right. The fear is this new one is going to be much quicker to jump back and forth to people and infect people. Right around here, October 31st. It looked like cases from that Delta strain were starting to go down, and then they started ramping back up, of course, because people are inside, people are closer together. They're more likely to pass that around. So cases in the U.S. were actually up something like 21%, 24% increase in the 7-day cases in the U.S. You'll see here in Europe as well. In Europe, it was 11% up a weekly change, and that was actually up even much higher last week from the week prior. Europe has actually been locking down some countries. I know Austria locked down. A couple other countries reimposed lockdowns because that caseload got so high once again. And it hit it hit the market. It hit the market hard, like we said. You can see here the sectors, the stock sectors of the of the S&P 500 index. S&P itself fell 2.25% Friday. Some of the hardest hits were obviously energy and financials. One, because energy, obviously, if we have more lockdowns or restrictions, I won't say lockdowns necessarily, but just restrictions on movement, then you're not going to get people traveling, you're not going to get people using airlines, and you're going to have less demand for energy. Slower economic growth, less demand for energy. So energy stocks took a big hit. It was actually a 13% fall in the price of crude oil on Friday, which is one of the top 10 worst sell-offs since in the last 20 years. A 20% one-day drop in crude prices, a huge drop. Financials got hit as well, financial stocks, so banks, insurance companies, things like that. And that was really a bet or a play off the interest rates, right? So interest rates fell by about 10%. The U.S. Treasury, 10-year Treasury rate fell down to about, I think it was 1.45%. It's about 10% lower than it was the day before, which is a huge move in interest rates. Okay, interest rates don't move that much. Interest rates generally move maybe 1% or 2%, on a big movement day. But to drop 10% for interest rates, that is a big move. And what happens with these financials is obviously interest rates, long-term interest rates, is how financials make their money, how banks make their money. They lend out that money on those long-term interest rates. So if those plunge, then you're looking at less profitability for the banks. So that's why those got hit. The industrials, materials stocks, those obviously got hit on lower economic growth. Technology and technology stocks got hit as well, and that was mainly on obviously the higher growth stocks. If we go into lockdown now, technology and communication services those were kind of a mixed bag actually in those two sectors. Because you did have some of the stocks, those lockdown stocks. So if you look on the right here, you see the biggest changes, biggest performers for the day, and you look through some of those. And Take-Two Interactive, so a gaming stock, you look through and. So you did have some technology stocks doing well. Netflix did well. And then in the communication services, you had some of those lockdown internet names, but you also had telecom stocks that did really well because those are more of a safety play. People aren't going to cancel their phone contract just because they're locked down, in case they're going to use their phone even more. So those did well. Really what outperformed, though, for the day was kind of obvious. It's the safety stocks. It's the stocks that sell those, consumer needs, those things that we buy, whether we're, locked down at home or out and about. So things like utilities, things like consumer staples, Clorox, Procter & Gamble, the Kroger companies, those came back in a big way Friday. Okay. And if you look here, so you can see the big winners obviously were the drug stocks, Moderna, Pfizer, Quest Diagnostics, any stock that might benefit from a need for a new vaccine. And we're going to talk about the new vaccines or need for a new vaccine pretty soon. Obviously, the ones got hit hardest. Royal Caribbean, the travel and leisure stocks. Royal Caribbean down 13%, Norwegian Cruise down 11%, Carnival. The top three, all those cruise line stocks, 10%, 11%. United Airlines down 10%. A lot of the travel, a lot of the airline stocks. And what worries me is, and we'll talk about this idea of maybe buying the dip or eventually buying the dip. And I know it is attractive. It is, you want to get a good deal on these stocks, especially, those cruise line stocks sold off 10%. You think it's a second opportunity. You think they might go up. The thing is, what worries me here about especially the cruise lines and the airlines is that those are really kind of an existential question for those stocks, for those companies, a binary, make or break kind of question for those. Okay. And what I mean is, so for the rest of the market, we've got, is the new variant, is Omicron going to be much worse? Is it going to need new vaccines, or we're going to go into lockdown, or is it going to be, no big deal? Is it going to be kind of like Delta, which, damaged the market, was a strain on the market, but really, didn't really hold the market back, didn't really hold consumer spending or the economic growth back. Okay, so you really got that binary question of yes, no on the new strain. Well, the problem is if the worst case scenario, if that Omicron strain does end up being as bad as it could be, and we go into lockdowns, we have lower economic growth, then there's obviously still going to be a lot of companies in the market. The majority of companies in the market are going to be eventually okay. Okay, we're still going to get a sell-off, and we're going to talk about maybe how a strategy around that. We're still going to see a sell-off in stocks, but it won't be an existential bankruptcy type question for those stocks. Okay, what you're seeing with the airlines and the cruises is if we do go into lockdowns again, if we do get serious travel restrictions again, there is a good chance that especially the cruise lines, they just don't survive. They obviously, there will always be a Carnival cruise line, there will be a Royal Caribbean group cruise lines, but they'll declare bankrupt, they'll wipe out all the investors in the stock, and they'll reorganize and come back. Same company, new stock, new investors. Okay, and why that is because obviously, yes, there will be more government stimulus money. There will probably be government handouts to a lot of these companies, but there's a point where these companies have already borrowed tens of billions of dollars to survive last year. If they're faced with having to borrow another tens of billions of dollars this year or next year, if this strain is really as bad as it could be, that's just going to be it. That's going to be an existential question for these stocks. So that's the one thing, if you are buying the dip, I know it's attractive to try to buy the dip on these travel and leisure stocks that have been hit the hardest. But I think maybe if you're going to wait, you wait on those and maybe pick up some of these other stocks that, were also hit, but it's not quite an existential question, right? So let's move on though. So we did talk about the travel and leisure stocks that all got crashed, that all got pushed fairly low down. I don't think now what I think here. Let's start getting into kind of how to play this, the scenarios that might come out. I don't think this becomes a March 2020 crash, right? Even in that worst case scenario though, okay? We still could see travel restrictions, lockdowns, a lot of pain in those travel and leisure stocks. But we've already gotten news from the virus makers, from Moderna, from Pfizer, AstraZeneca. They've all said that they can be have a new vaccine, and I got my notes here, but I lost them. They can have a new vaccine ready within I think it's like 6 weeks, right? They basically just kind of tweak the old vaccine to adjust to the mutations in the new strain, in the Omicron, and they ship that out. Now, obviously, that's still going to be very bad news because, it's going to take months and months to revaccinate people, to get people booster shots of this new vaccine. So we'll still have some kind of lockdowns or restrictions, things like that. But, it's not going to be quite what we saw in March 2020 where, stock market was down 35%, that kind of thing. Again, what scares me for those travel and leisure stocks, those ones specifically, though, is it is a real bankruptcy risk in that scenario. So instead, if you are going to be buying the dip, and we'll talk about when to do that and how to do that, then I think maybe you go with some of the others. You'll go with the energy stocks. You go with the interest rate sensitive stocks like banks and financials. You go with some of the tech stocks that aren't necessarily lockdown stocks, right? Because those companies, they're still going to be around. Even in the worst case scenario, they're still going to be around. We've still got great economic growth being posted, upwards of 5% and 6% a quarter. That's going to support energy prices. That's going to support oil prices. Those energy stocks will come back. Okay, those banks will come back as interest rates increase. Until then, now what I'm thinking here for the bit dip, I do not think you rush into buying the dip on Monday, even this week. We've already got news from BioNTech, which is the partner with Pfizer on their vaccine. They've said it's going to be about 2 weeks before they get data out on this, on this new strain, whether the vaccines, the current vaccines are going to be effective against it, whether they're going to need to tweak it or what. This is going to be about 2 weeks, right? Even if they're being pessimistic on that, even if it's a week and a half, you're still looking at a pretty volatile and uncertain week for this week to come. Okay, so at best, I do not think we get any kind of vaccine news this week that relieves that tension, that relieves that uncertainty. What is a higher possibility, though, is that we hear more countries discovering cases of this new strain within their borders. Okay, we've already seen that. We've already seen it, and I could just bring up the news here. The Omicron, the variant, is already in the Netherlands, Denmark, Australia. It was reported in London yesterday, I think, Germany as well today. So this thing is spreading, and just like we saw with Delta, they locked down a lot of companies or a lot of countries, travel restrictions from a lot of countries when Delta was discovered. It didn't really help, did it? These things they tend to get around, right? That's what a virus does. It's gonna spread. Okay, so this Omicron variant is already, in so many countries, and it's already spreading so wildly that I do not think you're gonna be effective at keeping it out from a global transmission, kind of like the Delta variant that we saw, earlier in the year. Now, what does that mean? That means it could be just a matter of time before we get a news headline that says Omicron variant discovered in the U.S., a case in the U.S., right? And that is obviously going to be another down leg to the market. That is going to be a shock to a scare to the market. People are mostly expecting it, but on that confirmation, we could see another sell-off. Okay, so what I'm thinking here is, especially this next week, there could be a rebound, a relief rally, so to speak, on Monday in stocks, just because they were down so hard on Friday, people trying to buy the dip, that kind of thing. But the thing is, it's not going to be on any news. There's still going to be that fear, that uncertainty in the market if this thing gets any worse, right? We're probably not going to get any real news on it for at least a week. We have that very real possibility that we get bad news within the week. So even if stocks are up on Monday, I don't think you buy into that dip. I think you wait. I don't think you're going to miss out on a big rebound, even if it does come up marginally on Monday. Basically, just kind of a dead cat bounce. Okay. Now, a real strategy, how you play this. So obviously the lockdown stocks could do very well, especially this week. Actually highlighted a few of those lockdown stocks that are in oversold territory. Highlighted those in Friday's video. Friday's video is instantly, it's already at like 25,000 views. Doing great because, these are some solid oversold stocks. We actually went through 2 technical indicators that said they were oversold, they were ready for a rebound, and that was before the variant hit. Okay, so Peloton was among them. I think On24 was on them. Among them, just a lot of those stocks that could be getting a boost from the variant, as well as just fundamentally oversold cheap stocks. So check that out, the Friday's video on that. So now a little bit more strategic, though, is should you buy the dip? How do you buy this dip and when? Okay. Now, obviously, first of all, this is why you do hold some cash. Okay. This is why you hold some cash, some bonds, other assets at all times. And I know bonds are kind of trash right now. Cash isn't much better because you're losing, about 5% of that each year on inflation. Some other assets, though, real estate, crypto, anything else you can hold, even a small portion of your portfolio, say 15, 20, 25%, is going to give you that opportunity to buy these dips. You're not going to be fully invested, right? Saw in our Facebook group last week, somebody saying they bought the dip on PayPal and bought it all the way down. And now it's like a third of their portfolio. Okay, that's what you don't want to do. You want to use this strategy that I'm going to share with you for buying the dip, making sure that you can get the bottom in the prices and don't really have to time the market perfectly. Okay, so again, just a lesson that you need to hold some cash, bonds, other assets like real estate stocks, things like that, just to kind of protect your portfolio from these big sell-offs. If you do have some cash or bonds, what I would do and what I usually do is plan on maybe a 3-step buying program. Okay, so when you are tempted to get back into the market to buy that dip, then maybe you take 25% of your cash, your bonds, that ammunition, right? That dry powder that you've got saved away. Maybe you take about 25% of that and buy into those companies that you really like. Okay, again, I probably wouldn't do that until maybe Friday at the earliest, Thursday or Friday, because I don't think we get any good news until then. You're still going to have that fear and uncertainty in the market, and it's still going to be a volatile week for stocks. So at earliest, I would probably consider buying the dip earliest later this week. And again, only maybe a quarter of your dry powder, of your cash, of your of the bonds that you can sell out of your portfolio to take advantage of those prices. Then, maybe you plan another 25% of that, so another quarter of your cash in a few weeks, in a couple of weeks, or if any news drops on the variant, any good news, obviously that is, or you just make what you do, you look at the S&P 500, you say, okay, the S&P 500 is around, I think 4,500 right now. If it drops by 10%, then I'm going to put another 25% of my cash back into stocks. I'm going to buy the dip at that point, and then you're going to hold the other half. So the rest of your cash, the rest of your bonds, the rest of your assets that you can sell off and take advantage of those prices, you're going to hold that for that deeper sell-off. The really worst case scenario, if the market falls by 20%, 25% because of this new variant, you're going to have that money set aside to buy that dip. And hey, even if it gets worse, even if stocks do end up falling 30% or 35%, which I don't think they will, but even if it does get worse, you still made a pretty good decision there by waiting with half of your cash to buy on that bigger dip, that bigger 20%, 15-20% dip on that. And why I like this kind of strategic plan for buying on dips and things like that is twofold. One is, you don't have to time the market. You can get in, you're going to get in on very good prices because you're holding your money back just in case it does come down. Stocks do come down. So you're going to get good deals at 5% down, 10, 15% down, 20% down. You're going to get those prices, and you're not going to push all your money in all at once. Okay, so that's one. The second reason why I like it, and this is even more so, is it's just so much less stressful. Okay, this is a stress-free, strategic way to invest, to buy those dips. You don't have to be watching the market every single day, every single hour, right? I see a lot of people, just worrying, tearing their hair out over the hourly moves in the market, wondering, okay, should I buy now? Should I buy now? Should I buy now? And really, it's unnecessary. You don't need to stress out that much over the market. It doesn't need to ruin your day. Okay, if you've got a plan like this, where you know exactly when you're going to buy those dips, you're going to buy it 5% down, you're going to buy it 10% down, you're going to buy it 15 or 20% down. You know when you're going to take that cash out of your portfolio and put it back into stocks, then you don't have to worry about it. Okay, you've got markers, you've got a strategic, you got a legitimate strategy, a formalized strategy, and it's just going to be much less stressful. So absolutely, use something like that. Again, we probably won't know any good news for that variant, for the Omicron, at least for a week or more. It's going to be at least probably about 2 weeks before we get data on that, but the risk is definitely to the downside on a headline of spread, okay, which is likely to be. You just don't keep these variants out of borders, even with travel restrictions. So I would probably wait. That would probably be maybe my first step in that buy the dip sell-off, is when we do get news that maybe the variant is discovered, a case is discovered here in the United States, and stocks fall off of that, and maybe that's where you buy that first dip. Okay. Now, I wouldn't necessarily recommend selling either, though. Okay, so we're mostly holding right here, waiting to buy the dip, because any news on the variant is probably going to be immediately priced into stocks. Okay, so basically, we know where it is right now. Stocks are priced on that. If there is a case reported, stocks are going to fall instantly, and that's where it's going to be. So you don't necessarily make any money by selling after the news, because that news is already priced in. So basically, you basically right now, if you're selling, you're playing scientist, guessing if the variant is going to be better or worse. And I'm not an epidemiologist, so I can't do that. So I'm just going to hold, use that strategic plan for buying more, for buying on that dip, and be a long-term investor. If you're in long-term stocks that you like and then holding and use that dip to buy more with a strategic buying plan, then that's the best investing I think you can do. But the best plan probably, is to just really use this experience to remind yourself that you do always want some cash, some other assets for that strategic buying. Like we said, if you do have cash and bonds that you can sell now and take advantage of these prices, then so much more the better. I see a lot of investors that are habitually fully invested, 100% invested, and in fact have borrowed on margin. And if you're 50% margin, then Friday was an even worse day for you because you're down like 3.5% on just the market. You could be down 15, 20, 30%. If you're heavily margined into some of those travel and leisure stocks, things like that. So definitely hold some cash and assets back to do that strategic buying. I do still like the liquidity plays here, besides like what we talked about with energy and financial stocks. I think those will do well. But those liquidity plays, those are ones that do better on that inflation, that do better with that reflation trade. Because, okay, you've got two scenarios here. Okay, you've got if the virus is worse, if we do get some kind of more restrictions, lockdowns, things like that, there's going to be more stimulus. Okay, the government is just going to throw more money at this. Interest rates are going to remain low. And we're eventually going to see even higher inflation than we already are. Okay, we're going to see more inflation. We're going to see more money pumped into the system, and you're going to see those liquidity plays, those reflation plays, really keep taking off. Okay, and so what I mean by that is, again, energy, crude prices. Since it's a commodity, it holds its value to the dollar, and it really is boosted by that stimulus money and the economic growth. You've got banks, financial stocks, things like that, but also things like Bitcoin and cryptocurrencies. Okay, obviously those are going to hold their value against inflation, against a destruction of the dollar through that constant stimulus, through that constant cash boost in the economy. So you've got those liquidity plays that I think will do really well if the variant is worse and we do get more stimulus money, but they're still going to do well as also if the variant turns out to be no big deal. Okay, because they were already doing well before the variant was reported. They'll continue to do well because we had like 26% growth in the money supply last year, just because of all that money, the $10 trillion plus pumped into the economy by the Fed, by the government, as well as globally. All that money pumped into the economy with nowhere to go. So it went into those reflation and those inflation plays. So definitely like those stocks. And yeah, I think, again, I think you wait to buy the dip no earlier than late this week, and even waiting further on with that strategic idea. So now I want to turn it over to the Q&A section. Obviously, my favorite section of or favorite part of the live stream, just kind of talking back and forth with you. I'm going to scroll up and see which questions we have. If I don't see your question, please ask it again in the chat below. Make sure you use a question mark so I can see that it is a question. So let's scroll back up here again. I appreciate, thank you everybody for being here. It has been a while since I've been able to do one of these live streams because I've got that project dropping on December 6th that is going to be a huge project for 2022 here on the channel. So be watching for that. Okay. What else? What do we have? Not by a deep crash. Something else. Okay, Andy, Semper Fi. Hoorah, brother. What else we got? T-Doc about to go to the moon. I don't know about the moon. I do own shares of Teladoc. I think it's a great long-term play. Obviously, it's been hit. It's still kind of a growth stock, so there still could be a sell-off, especially, with these growth stocks, these Teladoc, a lot of the stocks that really have shot to the moon over this last year, those ARC innovation stocks, think of those. They still, could be in trouble. Okay, they'll do well in the lockdown most likely, but eventually the Federal Reserve has to start pulling back this money, and they've actually started pulling back the amount of money, the $120 billion that they push out in the economy every month. They've started retracting that, not pushing so much each month. Eventually interest rates are going to rise and those stocks will get hit, so it's just a matter of how long does that liquidity last? How high do those stocks go in that time? And really that long-term picture. I'm in Teladoc for the long term because I think it is revolutionary for the healthcare space, for the medical space. But be ready for some pain in it, because it could just as easily go down over the next year, and you're going to have to wait for a while on it. What else? 360 Finance wants to know what firm I worked with in equity research. I did a lot of work freelance in equity research, so I worked with directly with the analysts at Bank of America. I worked with a couple at Morgan Stanley, basically doing their analyst reports for them. I did a lot of their research for them. I also set up a venture capital a sell-side research department for a Canadian venture capital company. Managed that for about 3 years, managed all the analysts under me in that sell-side research department. And basically what that is, in stock analysts, you've got sell side and you've got buy side. Okay, so buy side is working internally for the company. They're working for like Morgan Stanley, Goldman Sachs, JP Morgan. And they're telling the portfolio managers what to buy, right? It's not generally public information until the portfolio managers say anything. But they're reporting to the portfolio managers saying, hey, I think Tesla can go higher. You should buy Tesla. Sell side analysis is really what you see on TV mostly, right? On CNBC, on Bloomberg. Those are the analysts that are talking to the public. They're telling the public what to buy, and researching stocks for the public. And the idea there is that, if you become a good analyst and you really have some good picks, then people are going to come and come to your company and invest with you. They're going to invest because of that. And the company makes money off those brokerage commissions when people place their money with it. So I ran that sell side business with the venture capital department, had about 5 analysts working under me and managed their reports and stuff like that. I think it was Friday, but worth watching later today. So yeah, WTI crude price is down 13%, which was just a monster move on Friday. I like crude. I think it will go higher. Obviously there's still the risk to the downside, but I really do like crude oil and energy stocks right now. They had some great support under them before this variant, and I think they will afterwards as well. What else? So Ivan, good to see you there. Thank you for that 200 ruble super chat. I appreciate that. It has been a while. Everything's good. Just really burning the candle on this special 2022 project that's out on the 6th, and be watching for that. What do you think about the crypto for the next months or weeks? Thoughts on BTC miners? Okay, so 2 questions there. What do I think of cryptocurrencies over the next months or weeks? Obviously we've seen some weakness in prices. I was kind of surprised that it hasn't fallen more over the weekend, right? We saw about a 7 or 8% move on Bitcoin and some of those cryptocurrencies. Friday with the rest of the market, obviously people just selling out of assets, pushing their money back into safety stocks, safety sectors like utilities, consumer staples. So cryptocurrencies got hit. They're already down maybe about 15% from the highs about a couple weeks earlier. And the short term on crypto is tough. It's really kind of a fool's errand, right? Because you see all these technical stories, these technical news on, if it can hold the $55,000 level, it should go to 60. Well, nobody really knows. Okay, cryptocurrencies, the pricing on it is so new that we really don't have good pricing trends and things like that for the short term. So nobody really knows months or weeks. Okay, I am encouraged by the fact that cryptocurrencies, Bitcoin and that haven't come down any more than they have. They came down to about 50% off, about 30% or 30,000 on Bitcoin from that April high, came down about 50%, built back up to a new all-time high, and now they're down maybe about 20%. Now, what I'm saying here is you saw that previous high in 2017, hit about 19,000 in December, and it came down all the way to 80%. That's because a lot of the investors were still very unsure. They were still very short-term investors in it at that point, and they just all jumped ship. Okay, down 80% over the next year. Whereas at this point, we're starting to see a lot more long-term institutional players. You're starting to see a lot more long-term investors like myself that believe in that long-term blockchain strategy and how blockchain is going to change different sectors of the economy, how these cryptocurrencies are going to be used in that. So you don't see the massive selling, okay? Even though Bitcoin is down like 20% from its all-time high just a few weeks ago, it doesn't feel like a big panic sell-off crash kind of thing, right? So, I think you can take that as encouragement. You can take that as a view that as we do get more, more people coming into the space, and what I'm looking at a lot on that is not only the fundamental upside to cryptocurrency and the valuation, but just the fact that there is so much money going into these cryptocurrency platforms like Binance and Coinbase and all these platforms and all these miners and all that. And they're spending it out on marketing, okay? They're spending billions and billions of dollars marketing, trying to bring more people into cryptocurrency investment. And we'll talk about this as far as like the Bitcoin miners, the platforms, other Bitcoin-related stocks, right? Whether you should invest directly in Bitcoin or the stocks themselves. I am much more on favor of investing in the actual cryptocurrencies themselves. And why? Because you've got Coinbase, you've got Binance, you've got 100 different platforms out there that you can invest in, or the miners, things like that. Now, what you don't know is so you've got really a kind of a binary, okay? If Bitcoin does well, if cryptocurrencies do well, keep on rising, then yeah, these platforms, the miners, all these other companies are going to do well. If it doesn't, then the miners and the platforms are gonna get crushed as well. Okay, you don't need Coinbase if you don't need Bitcoin. If there's no Bitcoin, no Ethereum, you don't need Coinbase, right? If Bitcoin, if Ethereum does well, yeah, the platforms are going to do well. But you don't necessarily know which platforms are going to do well. Okay, what I'm saying is you don't know if Coinbase is going to still be the top platform. Okay, you saw how fees came down on stock trading, right? Fees are now zero on most stock trading apps, most platforms, right? And I think we're going to see the same thing in cryptocurrency. We're going to see those fees come down. And that's how a lot of those platforms, that's how, Robinhood, that's how Coinbase, that's how Binance, that's how a lot of those platforms make their money. So as those fees come down, you could see a lot of the platforms get into trouble. But you could still see cryptocurrency do really well. Okay, so the platforms need cryptocurrencies to do well. Cryptocurrency doesn't necessarily need any of these individual platforms or miners or any of those stocks to do well. To also do well. Okay, so that's why I'm in Bitcoin, I'm in Ethereum, I'm in Cardano, Matic, Polygon Matic. I'm in the individual coins themselves because I think they'll do much better, and you've got a much better certainty that those are going to do better than the miners, than the platforms, things like that. I think Coinbase will do well. I think they will, but I'm not betting on them versus the cryptocurrencies. So great question there. Great couple questions. What else we got? Make sure you hit a question mark in there if you're asking questions, so I can see that it is a question. Okay, UBG Flyer got, if the new strain is not as bad as previous strains, will the driver of correction shift to interest rates and inflation? Okay, that's a great question, because I have seen some news lately that a lot of the sell-off was just using the new variant as an excuse, right? We are very far along on the vaccine development, on treatments. We've actually got pills and treatments that aren't necessarily the vaccine, but just an oral pill that you can take when you start having symptoms. So we are very far along on vaccines, on treatments for this thing. And I would put the odds in favor of this new variant not being that bad. Even if we do need a new vaccine, even if we do need other antibody treatments, things like that, it's not going to be nearly as bad as it was last year. And so I would put the odds on that, and there's still a good chance that the vaccine is still going to be effective against this variant, even that. Okay, so the odds are still in the market's favor, but like I said, I've seen news that or analyst research that says, hey, stocks we're already at all-time highs. We're at near record valuations as far as price to earnings, price to sales, things like that. So it was really just kind of an excuse as well to take some profits, things like that. And what I'm saying here for your question is, yeah, if the new strain turns out not to be as bad as previous strains or as expected, which I think it will eventually after a few weeks when we get that data, then I think you're still going to have those other reasons for a correction, those other drivers. Okay. So if we do get some good news on the strain within, a couple of weeks here, then I think you see stocks rebound. Retail sales are supposed to be very good for the holiday season. Households are still flush with cash, got a lot of cash on the sidelines waiting to be spent. So I think you still have a lot of good economic news there. But stocks can't stay in the mountains forever. They can't hit these peaks forever. And I think interest rates and inflation is eventually going to be that correction. I think the Fed is still playing naive to how permanent or how long-term this inflation story really is. If you've been watching the channel, I've talked a lot about the rent, wages and the rent side of inflation that I think is going to be really the next shoe to drop. Basically, what the Fed is saying is that this inflation that hit like 6% last month, 6% year over year, which was the highest in about 30 years, highest since the 70s, that it's temporary, that a lot of this inflation that we're seeing was because of supply chain measures, because of lockdown things and, things being sold out and things like that. And part of that is true. But what I think they're missing is the next shoe to drop, the next thing to make inflation stay higher, to be stickier, right? One is wages, okay? There are like 10 million jobs available in the US and only 7 million unemployed workers, only 7 million people looking for those jobs. So employers are having to offer bonuses. They're having to increase their wages. Most of the fast food and retailers are now at $15 an hour or planning to get there very quickly. Obviously, you start increasing wages, people start buying more. If you don't have enough in stock, then you're going to raise your prices on things. A lot of if you were out for Black Friday, you saw a lot of stores didn't have the sales that they used to in the past. They didn't have those huge doorbuster sales, and it's a lot of that reason is, hey, if you're going to sell out anyway, you might as well keep your prices high, make more money, and really not have to mark things down quite so much. So I think you're going to see higher inflation on those wages. Bigger there is really the rent picture. We saw rents over the last year and a half, or median house prices, right, just explode. House prices are up 16-20% over the last year, which is another record. All the way back to the to the housing boom that we haven't seen prices jump that much. What we didn't see though was the rent prices increase, right? Rent prices have actually only increased by about 2.5%, year over year. And actually, I want to show you where to find this because I think this is really important that you be able to find this stuff and follow it on your own. But if you go here to the Federal Reserve Economic Data, this is FRED, and this is just a great data source. It's all the economic data that comes out of the government. So you can see, just in my drop down, I always look at the CPI, the consumer inflation. I'm looking at the balance sheet of the Fed, how much money they're pumping into the system, and I'm looking at this owner's equivalent rent. Okay, so you're going to look here, owner's equivalent rent, and this is the part of inflation, the part of that consumer price index, that CPI, that is rents, equivalent rent of residences, and this is the U.S. average. This is about a third of that CPI number, right? So this is a big part of the consumer inflation, and this is what really drives consumer inflation, okay? And if we change this graph, edit graph, to percent change from year over year, okay? And what we see is, if you look, this is all the way back to 85, and you can see, okay, so back in 85 when we had a lot of inflation, it was around 5% a year rent increases. And it dropped down to about 3% in the 90s when inflation wasn't too bad. And, it's been right around here, 2.5%, 3%. This last year, though, look at this. This last year, rent increases 2% for about 6 months there, only about 2% rent increases year over year. It is just now up to 3%. And so obviously it's getting back up to that historical average. And I think it's going to go much higher because, if you look, you can edit this graph. We'll add a line and we'll do median home prices. Median sales price, houses sold in the U.S. So this is the price of houses in the U.S. And this is year over year. Okay, so we're gonna do that, and we're gonna do 1 year. Now look at this. Okay, so house prices in the U.S. up 18.6%, up 19.9%. Okay, so the year to the third quarter of 2021, over the last year, housing prices have jumped 20%. And if we look further back, you haven't seen that for decades. Even in the housing boom, you really didn't see 20% year over year price increases. But rents, have only increased 2.5%, maybe 2.5%, 3% at the most right now, just this last month. And why is that? You would think if houses are so much more valuable, then landlords, they're going to be raising the rent because, they want to get the same level of return, right? They want to make a return on their, on their investments as well. So if the houses are so much more expensive, and they can't get the rent, then they might as well just sell it, right? They might as well just sell the house if they can't get more rent. And what happened over the last year is because of those rent controls, because of the moratorium on evictions, on foreclosures, you couldn't kick someone out if they didn't pay their rent. Well, landlords aren't going to raise the rent if they can't, if there's zero chance of them collecting it. If people are just going to fall behind and not pay it and then move out, they're not going to raise the rent, right? So that's why you saw, 20% year over year increase in housing prices, but nothing on rent prices. Well, when those moratoriums come off, you can now start raising the rents or evict people. Those landlords, they're going to start raising the rents. And that's going to be the next shoe to drop on this inflation. That's why I think inflation is here to stay. It's going to be a lot higher, a lot stickier than the Fed or all these economists think, because they're not watching these rent increases. They're not building that into prices. If we look at this, rent prices should be, somewhere in the order of 10% higher than they already are right now. If they're going to keep up with housing prices. If they kept up with housing prices over the last year, rent prices would be about 10% higher, I think, and that is going to feed into that inflation picture. So I definitely think we're going to see more inflation over the next year, and eventually it's going to be a hit to a lot of these growth stocks that we talk about, a lot of the tech stocks. It's going to be a hit to the general market. Okay, that's going to force the Federal Reserve to raise rates faster, to do their taper faster, and you're finally going to see a little bit higher sell-off. You're definitely going to see uncertainty and volatility in 2022. Okay, what else we got here? Okay. Omicron is a mutation. They were expecting mutations. Trying to scroll through and see questions here. What the market do tomorrow on the first 3 hours? Yeah. Again, I think there's a good chance we get a relief rally on Monday. Just because the market was so bad Friday. By the way, thank you for that question, Matisse. I do think there's a good chance we get a relief rally on Monday morning, early Monday. If you look at Bitcoin and you look at cryptocurrencies, they really haven't dropped any more than they did on Friday. They've really been kind of stable. So I don't think that overwhelming fear is still in the market. We do get a relief rally, but again, I don't think you buy into that. I don't think you buy too much into that rally because, like I said, we're probably not getting any good news on this variant, on this new strain, for at least a week, maybe 2 weeks or even more. And there's a very real possibility that we get bad news. We get news that they discover cases in more countries, including the U.S. And that kind of thing. So I think the shoe to drop is the bad news. I don't think you. I don't think I think the risk is definitely to the downside on that. So I wouldn't quite be buying the dip yet on Monday, even if we do get a relief rally. What are my opinion on REITs, real estate investment trusts? Mr. Wolfie 88 actually just did a video. I think it was last week, in fact, on real estate stocks. Let's go in here. I want to be able to show you which one it was, so you can look for that one, because I did the the entire one. Yep, right here. So scroll up so you can see it. Property profits. 5 best real estate stocks to buy for 2022. Check that one out. That is my strategy for real estate stocks for REITs in 2022. It's actually 5 stocks, 5 property types that I'm looking at. But more importantly, the one property type that I think could have a bad year next year. Okay, and I'll go ahead and just steal my own thunder on that. I think self-storage is set to underperform next year. We've just had 2 amazing years for self-storage. We're talking like things like public storage. We're talking about things like EXR, which is extra space storage. Those 2 stocks are up, 70, 80% over the last 2 years, which obviously is just huge for a real estate stock, for a property stock. Much more than any of the other REITs or the property types in the market. It's really just grown beyond the valuation. The dividend yields are so low on those stocks now because the prices have jumped and really haven't kept up with the valuations of the prices. So it's a lot of a valuation thing. So I wouldn't necessarily be jumping at those those self-storage stocks in the real estate space. I think I do highlight 3 property types in that video that you want to look at that I think are good value. I think retail can do well. I think office space can actually surprise. Now, obviously, with this news out this Friday of the Omicron of the variant, obviously, if that's more lockdowns, if that is worse than expected or worse than feared, then that's going to hit office space, and eventually going to be a buying opportunity for office space, because I think, take it from somebody that has worked from home for going on 8 years now, 7 years working from home, then there's always going to be the need for an office space. Okay, even I try to get out to a co-working space and something like that. Maybe once a week, maybe every a few times a month, just because for that interaction and for that kind of thing. But there's always going to be need for office space. Nobody's expecting office space to do anything this year. And a lot of those office space REITs like Boston Properties are in deeper discount mode or valuation than a lot of the other REITs. So I like office space. I think retail can do well, and I think medical or healthcare is another property type in there. But check out that video. It's the the video is about 6 days ago. I think it was last Monday. Check that out, and that'll highlight 5 stocks as well as the ones to avoid on that. But great question. What else? MA wants to know if I got a Twitter handle. I do, but I never use it. Honestly, for a guy that kind of lives by social media, has his business on social media, I don't use social media that much. I use, I'm in there in the community tab quite a bit for YouTube, so check that out. But as far as, and then we have our private Facebook group. If you want the link to that, check out the link that I've pinned in the chat here. Link to our free weekly bowtie newsletter. You'll find the link to the private Facebook group in there. It's a free newsletter. Sign up. I send it out every Sunday before the market opens the next day. All the trends and important news and things like that. So look for that link. You'll find the link to the Facebook group. So I'm in the Facebook group. Lurking more often than not. I'm there on YouTube, but all these other social media sites, Twitter, LinkedIn, all that, I just can't keep up with them. Okay, so I like staying on here on YouTube as well as Facebook. I am on Twitter. That's Stock Market J is the handle, but I rarely use it. What else do we have? REITs Rock, IRM, IVR. Yep. Actually, Iron Mountain is one of those. So Can't Beat the Bay says REITs Rock, IRM, IVR. I do actually have highlighted IRM, I think, in that real estate stocks video, but also in a dividend video coming up this week. Those weekly dividend portfolio. So be watching for that. Yes, I do like IRM. Iron Mountain, it's not where people go to get rich. Okay. Iron Mountain Storage, it's basically the de facto leader in physical record storage as well as digital storage. They're moving into that digital space and cloud storage and that kind of thing. So that's where the growth is. But the physical record storage is a very slow growth, maybe 2%, I think 2.5% growth, sales growth a year. But that lower growth keeps out all the competitors. So they are going to stay the de facto leader there. They're going to provide that dividend that's dividend safe, and then get a little bit higher upside growth from the digital storage as well. But yeah, look, good one. What else? Go DMAC. Nolan likes Elevate Credit. Yep, Elevate Credit was a penny stock. Recommended about a year ago, maybe a little bit more. Have recommended it a couple times on the channel. Elevate Credit, ELVT. I don't think it's a penny stock anymore. Haven't looked at it in a while because I know it is just blown up. One of the penny stocks that have really done well over the last year that we've been following. So not necessarily a penny stock anymore, but a great company nonetheless. What else? Who is the next Black Plague here? Fintech. Camille wants to know about Fintech. Not sure what your question is there. I mean, Fintech in general, obviously. With Fintech, you got to worry about the valuations there, what you're paying for it. That cheap stocks video that I covered on Friday is a good example of this. All 5 of those stocks that are now in oversold territory, and are good deals. Things like Peloton, things like On24, things like that. I mean, they were the big Fintech and new growth stocks of January and February of last year, trading for like 20 times price to sales, right? And people have just lost an enormous amount of money on them because they were because they were paying 20 or 30 times on a price to sales basis. Okay, folks, I know you love these innovative companies, right? These ARK Invest type of companies that are changing everything within their industry. And like I said, I like a lot of them. I own Teladoc, I own CRISPR Therapeutics, things like that. But you still have to use some reason, some rationale, and some caution when you're doing the valuations on these stocks. You still got to use some rational reasoning in what you're paying for these, because if you're paying anytime you're paying 20 or 30 times on a price to sales basis, that is very expensive. And for anything to change in the environment, not just the environment for these stocks themselves, for the company itself, but just for investors. If investors stop paying 20 or 30 times sales for these growth stocks, then those stocks are going to come down. Okay, even if the stocks still grow their earnings and their sales. I mean, I'm all for growth stocks. I'm all for these fintech and innovative companies, but I'm generally trying not to pay more than about 10 times on a price to sales basis. I mean, 10 times price to sales is still pretty expensive. It's still historically is still higher than you pay historically for a price to sales ratio, even for growth companies. But it's it's obviously a lot better than 20 times price to sales or 30 times. Okay, so just be watching for that for those fintech names. Square and PayPal look great long term. I do like both of those. I like Square and PayPal. I like PayPal better. Square, Jack Dorsey and what he's doing with some of buying some other companies. I'm not quite sure what his strategy is there. I'm not so sure that a lot of these other acquisitions are going to help Square. So I am much more positive, much more bullish on PayPal over the long term. A couple of notes on that. I mean, obviously PayPal, it is setting itself up to be an all-encompassing, all-in-one bank, all-in-one digital wallet for people. It's got the crypto, it's got your Venmo, it's got your digital wallet, all that kind of stuff. So it is setting itself up for, massive dominance in that digital wallet space, which is going to be huge over the next 10 years. Okay, so I do like PayPal. The thing you got to know about that, though, is, and like we said, someone in the FinCon or in the Facebook group, somebody in the Facebook group this last week said they got a third of their portfolio in PayPal because they keep buying the dip. You got to have that strategic buying plan that we talked about earlier. You got to have that in each individual stock as well. Okay, so you're not constantly buying more shares every time it falls every day. Okay, you can't be going back to a stock every day saying, "Oh, it's down 1%. I'm going to buy that dip." Because eventually, you get 30% or 50% of your money in one stock. Now, I don't think PayPal has anything to worry about. I think they're going to be there and they're going to grow, over the long term. But, what happens if you put your money into something like for example, the coal stocks of about 5-6 years ago, Peabody, a lot of those other coal stocks, they seemed like great deals. People bought the dips and they lost fortunes when those companies bankrupted because, it does happen. You never want, I'd say more than even 10%. I usually say between 5 to 7% of your money maximum in any one single stock. No more than that, just in case the worst case happens. Enron was a huge company, a huge success story until it wasn't, until it was bankrupt. So this kind of news, fraud or manipulation or the kind of news that you just can't predict can come out for any company, and so even the best of companies, even a PayPal, which I do really like, you can't have, more than 10% of your portfolio in any single stock like that. Okay. How about popular airlines such as Delta in the U.S. and Air Canada? Smart One wants to know about popular airlines, Delta in the U.S., Air Canada in obviously Canada. Don't know much about Air Canada. I have covered the U.S. airlines. A couple things on those. One, I like Southwest a little bit better. And what you got to think about in the airlines is one, where they fly. The regionals are going to be much stronger because they're still not waiting on those international travelers. Okay, even without this new variant, international travel was still well below 2019 levels. Okay, business travel was still well below those levels. Okay, so you need the carriers that aren't as dependent on the business traveler, on the international traveler especially. So you're looking at the your regional carriers, maybe a little bit smaller carriers like Alaska, Air Alaska, Southwest Airlines I like. So that's one thing. Another thing, you want to look at their capacity needs, okay? And they actually disclose these in their financial statements. You can look at any of the airlines and see what kind of capacity on their flights do they need to make money, to start turning a profit. And what we see is actually Southwest is about the lowest. I think Delta is pretty close there too, but Southwest only needs, maybe about 77% of their seats full to start turning a profit. Whereas you get some of the other airlines like American, which is the highest, they need something like 95%. It's been a while since I've checked the statistics, so they probably changed. Check those out. But yeah, American needs something like 95%, more than 9 and 10 seats filled to start turning a profit. So much harder for them to start turning a profit than it would be for something like maybe a Delta or a Southwest Airlines. Again, that said, just like we talked about earlier, I would not be buying the dip Monday morning, when the market opens on these airlines, on these leisure stocks, these travel, cruise stocks, things like that, because I don't know that the pain is over yet. I think you can put your money, if you want to buy a dip, if you think the market's going to keep on going up, you can buy some of these other stocks that aren't going to be hit quite as hard with any bad news. I think you wait at least a week to start getting back into some of these travel and leisure stocks. What else do we have? Seems like a bargain now. Activision Blizzard seems like a bargain now. I like, that's Lucas says Activision Blizzard. I think you probably can start looking at Activision Blizzard. They've been hit so much by this scandal and by the CEO and that kind of thing. I do like gaming stocks. We actually added 3 gaming stocks about a month ago, 2 months ago, into our 2021 portfolio. They're doing okay. They're not doing great, but they're doing okay. But I do like gaming stocks. I think the gaming stocks are going to be the first to really benefit off of NFTs, off of the Metaverse, off of things like that. Okay, they're the best positioned to be early adopters and early beneficiaries of where the digital space is going, the digital NFTs. And the Metaverse, things like that. So I would look, definitely the gaming stocks are looking good now. What else died? Are you going in on XRP? So Darm wants to know if I'm buying XRP. I'm not. Sorry. As far as cryptocurrencies, I only own 5 cryptocurrencies, okay? And the vast majority of my investment is in Bitcoin and Ethereum. I know not sexy. I know they're not going to I mean, I say they're not going to make me rich, but they're still up 300% in the last year, that kind of thing, and more. Okay, so I think you can go with the safety plays there, Bitcoin and Ethereum. I think you could still get rich off those. I think you can still do a 5x your return on those and be much safer than some of these smaller ones. Now that said, I do own the Polygon Matic token. I do own Cardano. I do own Aave, so AAVE. I think those are the best setup for that DeFi, that decentralized finance space, for the actual use case of the blockchain. So I think, those are good. As for you get further down into these cryptocurrencies, and I just, honestly, I haven't done my homework in a lot of these. I know XRP is very popular and very well used, but you get further down in some of these and they just have no real investment case. It's still very much a speculative trading, gambling kind of case where you're just hoping that, the speculative fervor in these keeps on going up. There's more people that keep buying them. I would much rather be a longer term investor investing in the use cases like those smaller altcoins, as well as just the larger coins that are going to bring in the investors and that kind of thing. What else we got? Work. Does anyone know if... Okay, will Roku benefit from this new variant or not? Roku, haven't actually looked at it in a while. I think it's getting into oversold territory. I would look at it again. The thing with Roku is, what does it do that isn't being done by a lot of other stocks? Where is its competitive advantage for Roku? I think that's one thing you gotta ask, because even after the sell-off in Roku, I think it's still trading fairly expensively. I mean, we can go in here to the into the chart, see what it's trading for on a price to earnings basis. So look at that real quick just to see where it's at. Okay. Okay, so price to sales, it's still at 12 times price to sales. And I know now, obviously, and what's the sales growth there? It's 50% sales growth, so that's good. It's a strong sales growth. Trailing PE of 108, price to earnings to growth then would be about 2 times, which isn't spectacularly high. It's not a bad price to earnings to growth ratio. I think Tesla right now is at like 3.2 times price to earnings to growth. Okay, and that's just the price to earnings ratio divided by the growth. It's kind of an adapter, an adjuster for these high growth stocks, right? So you get a little bit better feel for the valuation on these. So Roku price to earnings to growth is about a 2 times, still kind of high. That price to sales still 12 times, which again, like I said, I try to stay no higher than maybe 10 times price to sales, because even that is still fairly high. I understand it can look attractive here because, you look at, 460, it's down about half from the June high. It's down about half from there, and it looks like a buy. But again, the thing is, I would just ask, okay, where is their competitive advantage? What are they doing that no one else is doing? Because, I see they offer the streaming of a lot of these things, but, we've got a streaming service as well that pretty much looks really similar to what Roku's doing. I've actually looked at the dashboard or the screen on each, and it looks almost identical. So I don't know what Roku is doing that none of these other streaming services or these streaming platforms can do. So I'd be worried about Roku. I'm not an investor, but it's worked well in the past. What else? Some of these individual stocks, I haven't looked at DMAC, so I really can't say one way or the other on that. Here, hide user. Okay, what else? You heard of Atlas USD token launched by Tai Lopez? I probably wouldn't invest in any cryptocurrencies launched by Tai Lopez, okay, or influencers, or what does he know about any of that? I don't know. Wolfpack Productions, thank you for that $5 super chat. I appreciate that. Any thoughts on Tesla with their announcement on joining the phone business? I had not actually heard that. That's interesting. Uh, I I don't know. Like I said, I haven't heard that news. I think it's a joke. I would not be surprised at all if Elon Musk sends out a tweet that says, "Hey, we're going to do a T phone." Basically since Apple keeps on saying that they're going to do an iCar, right? An Apple car. And that's the big talk about Apple and Tesla is that, if Apple starts making a car, then watch out Tesla, because Apple is just as popular and has just as much brand. So it would be bad news for Tesla. And of course, so that's something that Elon Musk and Tesla have to always deal with, is the news and the rumors around the Apple car. So yeah, I don't know that Tesla is jumping into the phone business. I would be concerned if they were, because what the hell does Tesla know about phones? Not to say that they don't have the money and the technology to develop something, but is it going to be money well spent? I think Tesla is at no loss for money to spend on R&D and things like that. I think if they're trying to go into new verticals like this, the phone business, no, I mean they need to be focusing on that self-driving robo-taxi future, which is really the future of the stock if it's going to have a future. So yeah, phone business, I don't think so. I would not place too much on that. Okay, what do you think of BTC will work as a hedge against inflation? Last time it didn't. Ivan, thank you for that. What do you think about BTC as a hedge against inflation? Short term, I don't think it is a hedge. I think the calls for Bitcoin or cryptocurrencies in general as a hedge against inflation, I don't know that you can make a correlation on it in the short term, because obviously, Bitcoin and cryptocurrencies are so volatile. They jump up so much that, over any week, over month, over even a few months, even 3 to 6 months, if you're trying to use Bitcoin as a hedge against inflation or following the price of Bitcoin as a hedge of inflation, it's just not going to work. Okay, because there's just so much going on with Bitcoin outside of an inflation hedge. That's why gold is such a good inflation hedge, because there's really not a whole lot else going on with gold. You got central bank buying, you got jewelry demand, you got some other stuff that's fairly stable, and all that stuff is fairly stable. So the only real question with gold is inflation. Inflation and interest rates. Those are the two main things that are going to affect the price of gold: inflation and interest rates, and through those, the value of the dollar. But you really don't get that with Bitcoin, because there are so many other things that affect the price right now that make that price volatile. Over the longer term, though, I do think it is a good inflation hedge. Over the longer term, I think you see that limited supply of Bitcoin, as well as even Ethereum. Now they're burning more Ethereum than they're creating right now. So even in Ethereum and some of these other coins, I think you do have some kind of a hedge against inflation. What else do we have? I'm out of coffee. How do you think the dollar will do relative to foreign currencies? Japanese yen, Swiss franc did well Friday. Dollar didn't. Are foreign markets a good bet? Mitch Alex, that is a very good question. It's a deep question. How will the dollar do against foreign currencies? The dollar strength has surprised me. It's surprised me over the last couple of months. It's at a 17-month high. And really it's just a function of people's bets that the Fed is going to start raising rates faster than expected. They're going to come out of that, and I don't think it's very well founded. Every time we get a sell-off in interest, or every time we get interest rates go higher, a sell-off in stocks, anything like that, due to inflation, and people thinking that the Fed is going to be more hawkish, then Chair Powell comes out and soothes the market. He plays daddy to the market, right? He says, we don't think inflation is going to be a problem. We think it's going to be temporary. We're watching the economy. We're more concerned about employment. And, he turns out to be just as dovish as he always has been. Okay. And I think he's going to remain so. I think every time I talked about this in the Bowtie weekly newsletter we have out, I talked about this a couple times that, I think it's a buying opportunity every time this market sells off on inflation, because, I think the Federal Reserve, especially Chair Powell, is more dovish than people believe. Okay. So what does that mean for the dollar? I think obviously, the dollar is going to lose some of that strength eventually when we do find out that the Fed is going to be more dovish than expected, that they're not going to be raising rates as quickly as they should, as they really should. They're not going to be raising rates because of Chair Powell. So I think actually the dollar is going to be a little bit weaker over the next year, maybe against some of these other currencies. Obviously it's different for the main currencies like the yen, the franc, and the euro versus maybe some of these emerging market currencies. I do think some of these emerging market currencies are probably going to be in trouble, a little bit more in trouble. I mean, obviously you see what's happening with the Turkish currency. It's been so long since I worked much in currencies, but with the Turkish currency as well as the forint, the Hungarian forint, a lot of these emerging market currencies really having a hard time just because the pandemic and interest rates and inflation hitting them more. So I think you get weakness in the emerging market currencies, you get weakness in the U.S. dollar. Ergo, I guess I think you do see a little bit relative strength in the yen, the franc, some of those other reserve currency kind of bets. Okay. Turkish lira. There you go. Took me a while to figure out to remember what the Turkish one was doing. I had turkey on Thursday. Yeah, not the same turkey, but I'm right there with you, Yakaway Tube. SoFi, somebody wants to know about SoFi. I like SoFi as a fintech leader, as an innovator in the space. I think, I think they're a lot like some of these other fintech companies that are still a little bit overvalued. We can look at the price to sales on that and understand here. I really haven't looked at SoFi in a while, so all I can really look at is kind of the valuation right now. So if we open that up, obviously, if we look at the drop, it really hasn't done that badly. I mean, if you consider a lot of these other hot growth names that have dropped 30-40%, it really hasn't done quite as bad. It's down 4%, so it's down maybe 18% from its November peak, and it's had several peaks here this year, June, the February one. So it's been able to rebound. So that is positive, that it's actually been able to rebound when a lot of these other growth stocks, these other fintech names and innovation companies that you see, they started selling off in February, March, and just haven't been able to do anything since. Whereas SoFi has been able to make a run at those peaks. So that's some strength. I think obviously it's it's in a good sector. It's in the financial sector there. So fintech, so that's helping it beat some of these other purely locked down plays. But you still see 16, almost 17 times on a price to sales basis. Okay, so it's still very expensive. I would probably wait. Like I said, I think, here in the next year, I think you get another sell-off with a lot of these growth names, a general sell-off in the market as some of that liquidity comes out, as interest rates do rise a little bit higher, as the Fed is forced to raise rates. So I still think you get a little bit better prices on some of these fintech names and growth stocks and things like that. Okay. The last few years I had another Tesla question. I'm probably not the best person to ask about Tesla. The Rick L says, with the last few years at high Tesla has run, do you believe its growth is much more sustainable or competition is catching up? Now with Tesla, what you got to understand with Tesla as a bull, on the bull case, okay, on the bear case for Tesla, there is no way that the EV market, the electric vehicle market alone sustains Tesla at its current valuations. Okay, like we're talking about, it's it's up at something like 214 times price to earnings, 3+ times on price to earnings to growth, very high, very expensive, and that is just not with the other automakers coming up on EV. The thing is with Tesla that you got to understand, if you're trying to find a bull case in that, is the upside to self-driving taxis and that self-driving service. Okay, that's where the big upside is for Tesla. That's if you look at the ARK Invest Big Ideas report they launched last year, 2021, it talks a lot about Tesla with how it could dominate that self-driving market for robo-taxis, for that platform, that kind of thing. That's where the money is at. That's where the valuation is at for Tesla. That's what people are watching for Tesla. Because if you look at, if you look at the valuation on Tesla right now, just in terms of electric vehicles, I mean, to justify that valuation, it has to just, dominate the entire car market for several years. Okay, it has to pretty much take the top spot from a lot of these other legacy makers. Not saying that it's not going to be a dominant player in electric vehicles, but there is going to be a point where the technology catches up, and a lot of these other legacy players are selling their many more units of their own vehicles. And so I think the valuation for Tesla in electric vehicles alone does not support the valuation. But if you're looking longer term, if you do believe in that robo-taxi, rideshare kind of idea, and you believe that Tesla is going to be further out in that technology, in that level 5 driving that we need to have those robo-taxis, that's where the money is at for Tesla. Yakaway says robo-taxi is a dream. It is a dream, but it's quickly becoming reality. They actually, there's a couple I know. Didi, I think Didi is almost fully approved for robo taxis for nobody in the taxi, no assistant in a couple cities in China. Here in the United States, I know there's a couple cities in Arizona and Southern California, San Francisco that are experimenting with robo rideshare. And I think there's like a person in the car from the company, but they're not behind the wheel, things like that, or they're just sitting there. We are at level 4 capabilities on robo taxis, that kind of thing, or not necessarily robo taxis, but on self-driving, that kind of thing. So I would say within 2 or 3 years, easily, we're at level 5 self-driving robo taxis, and and that's what's going to take a lot of these. And yes, Dear in Fear, I do remember the Total Recall robo-taxi guy was the Johnny Cab, I think was the guy, right? Johnny Cab, the robo-taxi. Good stuff, man. And there is only one Total Recall movie. Don't give me any of that. What was it, 2010 remake? If it's not Arnold, it's not Total Recall. Stake USDC. So Zach is asking about staking USDC for savings. That's what I'm doing a lot. I've got about $80,000 in USDC, which is the US stablecoin, USDC stablecoin there on BlockFi. It pays me 9%. I think 9% on up to 40,000 and like 8% up to for the rest. I've also got. I also have PAX, the PAX stablecoin for another 9% on that 40,000. So I've got about $120,000 in USDC stablecoins there on BlockFi earning interest. And that is my ammunition. Okay. That is, if this variant does get bad, that's the cash that I was talking about earlier for that strategic plan. That's the cash set aside, waiting for a bigger sell-off. I'm earning 8 and 9% on those anyway. So that's not a bad return. But I keep that cash on the sidelines, just in case I wanna buy into the market. Antonio says Series 7 I-bonds. I-bonds are paying about 7% right now. Also a good choice. I think you're limited to like $10,000 for I-bonds. If you don't know, I-bonds are a series of U.S. Treasury bonds, right? So backed by full faith and credit of the U.S. government, of the U.S. Treasury. No chance of default, right? But they're actually paying 7% right now. They're adjusted for inflation, that kind of thing. They were created, only a few decades ago to help savers. But yeah, they're paying like 7%. So, if you're not quite ready for stable coins, if you're not quite ready for some of these other things for cash, then I-bonds are a very good, solid way to hold your cash there. You do have to hold it for like 6 months or something. There's some penalties if you withdraw for before 6 months, something like that. So check that out. But that's 7% right now, so that's a good one. Okay. So Frank 0020 wants to know which is best, the 10-year Treasury bill or TIPS. I don't know that I would go with either. Basically TIPS are So treasury protected securities, basically it's basically the T-bill, the treasury bill protected with an inflation kicker, right? So it adjusts according to inflation. If you think inflation is going to be a little bit higher, then you buy TIPS instead of the T-bill because you're going to get that little extra bump with that. If you're going to be buying one of these, I'd say just buy the I bond, right? I'd say you get that 7% instead of, I think TIPS are right now maybe 4.5%, 5%. I haven't checked on them in a while, but definitely TIPS over T-bills, but I bonds over TIPS as well. Can I get I bonds? No, as in yin feet yang. I don't think you can get I bonds as a non-U.S. citizen. I think it's only available for U.S. citizens. You're also capped. The U.S. citizens are also capped at $10,000 each in those. So there are quite a few limitations to that. Again, and that's the reason why I would just go to stable coins on BlockFi or wherever they're paying interest. But I like BlockFi because they're a little bit higher rates on those. Okay, what do we go? What do you think about Baba? Oleg wants to know about Alibaba, the Chinese Amazon, basically, right? And this is actually a video I did a couple weeks ago on value stocks, long-term buy the dip value stocks kind of thing. I think Alibaba is probably the only Chinese stock I would buy right now. Maybe some of the other larger ones, maybe Tencent, Tencent's a good one. But Alibaba is probably about the only one I would buy if I was buying any Chinese stocks. I just can't pull the trigger on it though. There is just too much government risk. You just don't know what the Chinese government is going to do. They just recently, this last week, they fined, I think it was actually Alibaba. No, they fined a bunch of just a broad range of the technology companies. They fined them for past acquisitions that they hadn't reported somehow, something like that. So the government is still looking for ways to get money out of these companies and have a greater sense of control on the economy and on these companies. So I just don't think the risk and reward is worth it. Alibaba, yes, a great company, huge presence in China, dominating in that e-commerce segment. I think they have a future, but the risk return ratio just isn't there right now. So I think you'd have to be careful on that one. Mason wants to know, would you recommend investing in precious metals like silver, palladium, platinum, gold? I don't generally do the precious metals themselves. Now, I do have some money in gold, physical gold on the Vaulted platform. I've used that in the past and have bought gold on there. Buying precious metals, buying the physical metals, buying the physical metals usually comes with a pretty high fee. Okay, it's usually about 4%, which kind of sucks. Sometimes it's 4% each side, so buy and sell. So you have to have a pretty good upside on the price just to make any money. You've also got those, the storage fees, things like that. So I generally, if I'm in metals, if I'm in precious metals, I'm generally in the miners. Okay, and I'm buying the miners because, not only are you going to get that dividend yield, you don't have the storage fees, obviously, but these miners, they're leveraged, right? So they're leveraged onto that price. If the price of those metals go up, the miners generally tend to do better. Okay, now, obviously that works in reverse as well. If precious metal prices come down, the miners generally do worse than those precious metals prices, okay, because they do have that leverage and they're leveraged on those. So, if you do believe in precious metals prices, I think gold is positive here. I think it's already pretty expensive. Even if inflation is higher than expected, I think gold is pretty expensive. If you look at the annual rate of return, did this a couple of weeks ago, I think when I was looking at gold prices and inflation hedges. Actually, it was an inflation video I did about a month ago. Actually, I was looking at the price of gold, and if you look at the annualized rate of return on the price of gold over the last 30 years, it is up at 7% annualized, which is a pretty hefty return, right? It has come up quite a bit over the last 30 years, even adjusted for inflation. So I think, gold is already fairly expensive. I have worked kind of the gold silver ratio every once in a while to kind of trade and make money that way. But again, yeah, with miners, I'm generally with precious metals, I'm generally in the miners themselves. One thing you do want to look at especially if you're thinking electric vehicles and that kind of future. One thing that I'm kind of putting together an idea for a video right now is if you look at the demand for some of these minerals, these metals and minerals, right? Basically copper, nickel, a lot of these other minerals and industrial metals, but especially copper and nickel. They have huge demand coming up for electric vehicles. Okay, not just in like batteries and things like that, but in the vehicles themselves. They use something like 200 or 300% more copper in an electric vehicle than is used in your traditional combustion engine vehicle, right? So they're actually predicting, on electric vehicle sales over the next 5 or 10 years, they're actually predicting a fairly big deficit in copper supplies, over the next 5 or 10 years because of that. So, if you're looking at miners, I would definitely be looking at, at some of those minerals and metals miners, like I think maybe like gold, Great Panther mining. I think that was in Friday's video, highlighted in Friday's video. But also, any company that's doing the copper mining, that's doing nickel, things like that. One thing you do got to watch out for in the miners, especially the copper miners, is their jurisdiction, where they're mining at. Most of them are mining in Peru, Chile, that kind of thing. Fairly good business-friendly environments right now. But if we do get a supply crunch on copper, is the government going to change? Are they going to kind of expropriate some of those mines or raise fees and taxes, which it's likely they will? So I would much prefer taking the safe side and looking at those miners with the with the assets here in the U.S. and Canada in a little bit more stable, safer jurisdictions. Who I saw a question there. If I own Tesla, I do not own Tesla. I've owned Tesla in the past. I've sold it out. I just the valuation is just too high for me. I am an old school value investor. So when something gets that high, it's hard to hold on to in my portfolio. Not to say that I haven't missed out on some pretty good returns from them, things like that, but I've also made some pretty good returns as well. But right now, no, I'm not holding any Tesla. Okay, Honor H wants to talk about covered call ETFs. Actually, this is a video I did not too long ago, so I'm probably just going to kind of defer you to that. If you go to the channel, click on videos, and if you scroll down here, you go to right here, top 5 income ETFs to buy, QYLD, RYLD, JEPI. You're going to find a whole video on those covered call ETFs. Very popular, obviously, 34,000 views already in the last month. Those are the ones, and it's really interesting comparing these 5 covered call ETFs because they're using different strategies on different sets of stocks. So it's interesting that the QYLD is using it on the Nasdaq 100. So you've got very much a tech stock, growth stock kind of feel for that one, plus the dividend yield. Whereas some of the other ones, the RYLD, I think is on a broader. That's actually the small cap index. So you also get kind of a growthy kind of small cap returns on that. The JEPI, I believe, is a larger, broader market index on that one. So check out that that video, top 5 income ETFs to buy. Check that one out because that's going to give you all the pros and the cons and comparison on each of those companies, each of those stocks actually. Okay. What would you buy and hold for life? Good question. Joseph Ahmad wants to know, what would I buy and hold for life? Actually, I have a list of stocks I'm buying for the long term. I think, so in that list, I would include PayPal. I think PayPal, I mean, life is hopefully a long time for me, so it's hard to say, the next 50, 60, 70 years, hopefully. But definitely over the next 10 years, over the next 15 years, I would definitely be looking at PayPal. I would be looking at Salesforce.com, ticker CRM. I would be looking at, there's a lot of my stocks, most of my stocks, we're looking at things like, 5 years, 3 to 5 years or something like that out. Not necessarily life, but definitely. So PayPal, Salesforce. I also like some of the bank names. So Wells Fargo, I think, has a lot more room to run once they get out from under their problems. Some safer stuff like that. Wells Fargo, I know it's not a really popular company. It's not a real popular stock right now, but I think it's safer and it's still got a little bit more upside than most of your other bank stocks, your other financials, things like that. Transitory. Antonio wants to know, just says transitory with a question mark. I'm assuming that you think inflation is transitory. I do not think. I mean, there are parts of the current inflation, 6% last month, consumer price inflation. There are parts of that are transitory. We are seeing some suggestions, some indications that the supply chain is working itself out, and some of the inflation from that is going to be working itself out over the next few months. So that part is transitory, but like we talked about earlier in the video, I think there's the next shoe to drop in rents and worker wages that is going to keep that, going to keep inflation higher than is expected. So parts of it are transitory. I think the surprise though is to how permanent it really is. Alrighty. Okay, Morgan says, how bad can future sell-offs be for growth stocks? Some are down 50% on the year already, and it can get worse. It can get worse. And the very unscientific way to do this. I mean, if you look at, hell, you can just look at the Nasdaq, which is the larger cap, a lot of larger tech stocks, and you can just go here to 5 years. And you've got, so from December 2016 to, January of last year before the pandemic, 9150 from about 5,500. Okay. So pretty good. It's basically almost doubled, basically about a 20% annualized rate of return. I think it was like 16% or something over those, over those few years, which is a really good return for tech stocks for the market. Okay. So it was already doing pretty well. So already getting into that overvalued space. And then just look at what happened. Look at what happened in this last going on 2 years, from January 2020, before the pandemic, before the sell-off even, right around 9,100 on the Nasdaq Composite Index, now upwards of, it hit 16,000, so 7,000, is about 76%. It's about a 37% annualized return over the last 2 years, a little bit higher. Stocks just don't do that, so that is not a natural return, natural annual return on stocks. And you see this same thing. Let me shift it up a little bit so you can see a little bit better, but you just don't see this in stocks. You see this in the Nasdaq. You see that in the growth stocks that you're talking about. And it's no surprise. It doesn't take a rocket scientist to know what's going on. It's that $10 trillion that was forced into the economy from the Fed, from the government. Not to say we didn't need it to survive the pandemic, but the bill comes due, folks. The bill comes due in inflation, in those stock prices. That money got pushed into the economy, had nowhere to go because nobody was spending, nobody was going out. And so they put it in stocks, and they pushed these stocks all the way up into the stratosphere. So, you look back in history, and anytime stocks have done this kind of parabolic move, 2 years, 2 years in a row doing 35, 40% a year, then there's a payback. And so, if you just take, it depends on where you start from, but if you assume, a natural 12, 15% annualized return on tech stocks like this, or even in the general market of the S&P 500, if you assume a 10 to 12% annualized return from this point, stocks could fall down to, maybe even into 10, 12,000 and still be until they get to a decent valuation, right? I think the price to earnings ratio is somewhere around 21 for the forward ratio, whereas it's like, long-term average is closer to 16, 17, so stocks are still about 30%. And this is the S&P 500. Tech stocks are even higher, even more overvalued. Tech stocks are closer to be about 40% overvalued than that historical average on those valuations, on that price to earnings, on the price to earnings growth, on the price to sales ratio. So yes, worst case scenario, If all this liquidity comes out of the market like it's been pushed into the market over the last 2 years, if all that comes out and we have a panic, then yeah, stocks could come down, especially those growth stocks could come down another, 20, 30, 40%. No, I don't think that's going to necessarily happen overnight or have a panic or a crash. But, I would expect a 10 to 20% sell-off in 2022 at some point, because, you're getting the opposite of what we've benefited from, basically. Basically, we've all been, having a party over this last 2 years with all this money getting pushed into stocks, into the economy, having nowhere to go but stocks. And now we're going to pay for it. Now this next few years, we're going to have higher interest rates. We're not going to have as much money pushed out by the Fed, by the federal government. And that's just the payback. So, that's why I have money in cash. I have money in bonds and real estate, other assets that I can hold, that I can make a good return on, and, use it to buy that big sell-off when we eventually get there. At some point, if inflation going to push it down. So yeah, talking about the JP Morgan, the Jamie Dimon over there at JP Morgan talking shit about the Communist Chinese Party, saying JP Morgan would outlast the Communist Party, which, yeah, I mean, there's it's a possibility. Let me tell you about China right now, folks. Is they are, and you see, this is a lot of the reason why they're putting the screws on these tech companies, Bitcoin, really tightening their control on the government. This is the truth about China that a lot of people really aren't talking about, is they are really facing a problem over the next year or so with with growth and with capital flows and controls and things like that. Okay, the property sector is about a third of the economy in China, just because people invest. They don't really invest in stocks. They invest in property. They'll buy an apartment, just let it sit vacant because property prices have been going up for decades, and they know that it's a good investment, good safe investment. So property is about a third of the economy. Property developers are going bankrupt. Evergrande was just the tip of the iceberg. They've got it's like I did some research on this a few weeks ago. It's something like $40 billion in bonds and loans due to property companies in China over the next year. It's about $4 billion of that alone in January. So you're going to start seeing more defaults in January. That has not stopped. The defaults in China have not stopped yet. And that's just going to keep on bringing property prices down, going to bring that economic engine down for China. Now, what the Chinese government is looking at with this, they're looking at, okay, a major part of the economy is falling. It's going to be weak over the next year. One thing a government wants to control when its economic growth slows down and uncertainty kind of comes up is the currency. If you have your currency fall apart, then and decrease, especially relative to the dollar, then you start seeing a lot of these companies that borrowed in U.S. dollars for their bonds, they go bankrupt too, because they're making wands, they're making Chinese renminbi currency, right? But they're having to pay out dollars, which are now super, super expensive if the Chinese currency crashes or sells off. So they have to be able to control that currency. So what do? You shut off the ways that people can move currency outside of the country. Okay, you shut off Bitcoin. You outlaw a lot of those controls. You take control of the capital flows. So you do that. You take control of, you get greater control on these companies, especially these fintech companies that have that information and that ability to help people move money out of the country. You control the currency and that's what China is doing right now. They are taking a greater control on the economy, on these companies, on ways to move money out of the country in preparation for what could be a bad year for the economy. So that's what they're watching. That's why they're doing it. That's why JP Morgan CEO Jamie Dimon is saying, JP Morgan is going to outlive the CCP. Obviously, he had to walk that back because JP Morgan is trying to do business in China. So he had to take that back and say he was sorry on that. But he's not necessarily wrong. I do not think the Communist Party is going to fall in China. I do not think, whether JP Morgan outlasts it, I don't know. But the Communist Party isn't going to fall in China because, I mean, hell, they just control everything. They just take a tighter grip and, kill all dissenters and that kind of thing. They have the, another, what was it under Mao, the little black book or whatever that they did in I want to say the 60s or 70s with the massacres there. They just basically just take greater control and, they get through it. But anyway, we'll not talk about geopolitics for too long here. China doesn't want America making money off their stocks. Don't say that. If you don't hedge for volatility, Bitcoin sounds like less for the war. Oh, okay, come on. Dear and fair, do not. Somebody else talking like Elizabeth Warren, because it definitely wasn't me. I am not a fan of. I mean, I'm pretty progressive in a lot of my views, but definitely not a fan of Elizabeth Warren. I think she's just grandstanding for for her own political gain in a lot of things. So, but yeah, enough politics then. What else do we have? Metaverse ETFs. Okay. So Brad wants to know about Metaverse ETFs. I have not looked at these yet. I need to. I know, because I see videos popping up. I see comments and questions popping up about the Metaverse stocks, things like that. I have not looked at Metaverse stocks or ETFs yet, so I really can't tell you one way or the other. I know, obviously, you look at the big players in those. Obviously, Facebook has got, everybody likes to laugh at Facebook and changing their name to Meta and all that, but they've got the lead. Okay, so it's going to be Facebook in the Metaverse. It's going to be Nvidia is going to do very well because they have the computing power for that. I think it's going to be CRM, so Salesforce.com is going to do very well in the Metaverse. Because they've got a lot of that AI and the stuff that is going to help run it. I think they're going to develop a product for that. I think you're going to get the payments, the digital wallets going to do very well. So things like PayPal, things like Square are going to do very well in the Metaverse because you need those digital payments. You need a payment flow in that, and I think those will work very well in that. It's going to be hard to go wrong with the big players that are going to have other things they can do. I mean, I know a lot of people are looking at Metaverse names that, maybe smaller companies with more growth potential, but then you got to take the risk as well. You got to take the risk of some penny stock company and never really, growing into its own in that theme. Whereas you go with some of these larger players that are definitely going to benefit from that, and you're going to do well. I think the gaming stocks, a lot of the gaming companies like maybe Take-Two or some of the ones we added to our 2021 portfolio are going to do well, just because obviously that's where it's going to start. People are going to go to the Metaverse to play games and to play virtual games, things like that. So I think those companies will do well also. Okay. No problem, dear and fear. Yeah, I don't know. I have a hard spot with Elizabeth Warren because, I tend to be pretty middle of the road as far as my politics. And we won't get into that too much here. But with Warren, she just, she's always grandstanding, with a huge speech against everything. Basically, she is the anti everything, it seems, with the financial space. And since, I work in the financial space as part of my livelihood and part of my life, then, she's really rubbed me the wrong way a lot of times with, trying to regulate, and not say we don't need regulation in the financial space, because we do need consumer protections, but she's to the extreme a lot of times, in the financial space and cryptocurrencies and a lot of these. And I think she wants to be president. Let's call it what it is. She's grandstanding like most politicians do. She's grandstanding. She's trying to build a name for herself in that progressive wing of the party to be president someday, or at least vice president or something like that. So I just don't like politicians like that grandstand rather than actually think about things. What else? Caballero de la Eternidad. Great name there. How about Roblox? I haven't really looked at Roblox a whole lot just because it is pretty expensive. It is very expensive. But I do think if you're willing to let it play out and wait and let it grow in there, I think, obviously it is one of the ones that is also going to benefit from the Metaverse, from, the growth of the digital economy, things like that. It is just so expensive right now. And I'm pretty sure this was, one of those SPAC stocks, right? And I'm not a fan of those because they were just so inefficient. All these SPAC companies that came to market, they're just so expensive, so inefficient. So much money went to the promoters of those, So yeah, I'll share what I'm looking at with you. I mean, you look at this. Roblox still at 40 times sales. Okay, so yes, I think there is an immense amount of growth for this company, but how much is that growth is already built in? And where does it drop when some of that growth comes out? So if you, I mean, I do like the company. I do think it's got an innovative concept with that user generated gaming. I think if you look at those other user generated platforms, Facebook, YouTube, which is a huge growth engine for Google, right? So Facebook, YouTube, those user-generated platforms, and Roblox is like that. Roblox is that in the gaming space. So I think it's very innovative. It's it's going to make a lot of money, but it's just hard for a value investor like myself to pull the trigger on a price to sales of 40 times. Okay, and I mean we can look at. I'm sure it's like 100% sales growth. Yeah, 102% sales growth. So it's strong sales growth. It'll get there eventually. What you can do if you're not put off by this price to sales ratio like I am, I think, you put if you were going to invest $1,000 in it, right? You put maybe $350 in it now. You put maybe 500, maybe 500 of it now. Wait a year to see where it's at in a year. Because I do think you get better opportunities within a year, to buy it for a lower price to sales ratio for a lower valuation. But if you want to be in there, if you want to stake your claim in it now, then you put some of your money into it now and wait, wait in cash. Just like we talked with that strategy, is you wait some money in cash and you wait for a better opportunity later on. Just being shipped to central location, dropping nuke. Okay, feeding a huge population. Penny stock nowadays. Barnabas asking about penny stocks. Haven't actually done a penny stock video in a while. I got to do a penny stock video. Have to see what I can recommend for you right now, because it's been a couple months actually. I think since I've looked at penny stocks. Thing with penny stocks is they're so much a function of the environment, of that investor sentiment. So when investor sentiment gets weaker, you start seeing some of that liquidity come out of the market like we've seen over this last month or so, then it doesn't matter what penny stock you're in. It doesn't matter what company it is or how good it looks. All penny stocks get hit by it. So it's hard recommending penny stocks when that investor sentiment is coming out of the market. Okay, China buys food from the U.S. That's not all the dollars. Okay. Market volatility. What else? Balance. How do you balance the idea of buying value versus penny? So Lukoid wants to know, how do you balance the idea of buying value versus penny stocks? Okay. And this is all that portfolio allocation idea, right? So you have the different themes that you like. I like value stocks. Obviously dividends are in there. Dividends are big on my list. I do like penny stocks. I like cryptocurrencies, as well as energy. Energy is kind of in that value and dividend theme. So you got all the themes that you wanna buy. Okay, and a lot of that for me, comes from that top-down idea. Okay, what do I think are the sectors that are going to do well over the next year, 3 years, 5 years? So which are the sectors that I want to buy, and how do I want to plan that in my portfolio, or just themes like dividend stocks and things like that, and cryptocurrency. And then you just kind of break it down. The higher risk stuff like penny stocks, like cryptocurrency, you have a smaller part of your portfolio, right? So, and this is all going to depend on how tolerant of risk are, if you get freaked out by big market swings, things like that, or how long you have to needing your money. But, average investor, you're going to have maybe 50, 60, 70% of your money in stocks, right? And within that, you're going to have different themes and stocks in there. So dividends, value, growth, that kind of thing. You're going to have maybe 30% or maybe 10% in bonds, maybe another 10% in real estate, right? In real estate stocks, REITs, things like that. And that's going to provide your safety, your diversification. The bonds are going to provide that cash that you need when you want to buy the dip and things like that, your safety from a stock market crash. And then maybe you hold 10% of your overall wealth, of your overall portfolio, for those higher risk names, those higher risk themes like like cryptocurrency, like penny stocks, and you just divide it out in there. Maybe if you have a long time and you're very risk tolerant, maybe you jump that up to 20% even at the most. So maybe you have 10% in penny stocks, 10% in cryptocurrencies. Maybe you have some other stuff in there like that, but it's definitely kind of a portfolio allocation strategy kind of idea. Okay, I would never have 100% of my portfolio in Bitcoin or cryptocurrencies, or 100% in penny stocks or anything like that. Because you want that general, that strong market return, just juiced a little bit with some of those higher risk plays like penny stocks, like cryptocurrencies, things like that. So you don't need a lot in them. You don't need more than 15, 20% at the most in these high risk plays like penny stocks, like cryptocurrency, those high risk investments, because if they're doubling, even if you've got 15% of your money in those high risk plays and you double it in a year, that's already a 15% overall total portfolio return plus whatever you make on the stocks. So you don't need a whole lot in those high growth names. Covered calls given what are few stocks to do covered calls in? So Gil wants to know a few stocks that I would do covered calls in given the environment. So covered calls, obviously you sell a call option against your stock, and you collect that premium. It's kind of a cash return, but it's also a way to limit your downside risk, right? Because you're collecting that cash on it. You're saying that you probably don't think the stock price is going to go flying higher. It's maybe going to stay stable or even come down just a little bit. So basically you'd want to start from there. Which stocks are those that you like over the long term, but maybe short term they might be a little bit weaker, right? So for some of these, I would think maybe some of the financials. I have shares in NYCB, which is New York Community Bank. Pays a great dividend yield. I think right around the 6% range. So great dividend yield. But over the next over the next 2 or 3 months, we could be looking at a weak interest rate environment if this new strain of the coronavirus, is a factor. So we could be looking at, lower interest rates. So that would mean weakness in the bank stocks, in the financials. So, that kind of stock, that NYCB, maybe Wells Fargo, things like that, they wouldn't be jumping higher. Okay. So, that would probably be a good one to sell covered calls on. It's really just a matter of, which stocks do you think, will not jump higher. Okay. So I wouldn't be doing covered calls, obviously, on any deep value or discount stocks right now. But there's some names there. V Berg says, I look tired. I am tired. I was up till I think 6 this morning, working on that special project I got for 2022. Again, that's coming out. That's dropping on December 6th. I got 5 videos for 2022 starting on December 6th. Going to come out over 3 weeks. It's a huge project. Going to be really cool. Nobody's doing this on YouTube right now. I've never done it, and I really like how it's coming out. So definitely be watching for that. But it's the reason why I haven't been doing live streams lately, because I've been spending all my money working on those. I actually flew out to Kentucky last couple Sundays ago to work on that. So if that doesn't spark your interest, why I flew out to Kentucky, then check that out. Check out those videos starting on December 6th. Okay, what else? Well, we are on 2 hours into this live stream. I thank you everybody for being here. I love that you're here. I love connecting with you on this, but I gotta go. So thank you again. I will see you in tomorrow's video. Make sure you check that out, updating that weekly dividend stocks portfolio. So make sure you check that out.